Does all the investing jargon and lingo confuse you? Well, I'm hoping to demystify some of that today. Hi, I'm Patti Handy, your financial coach and mortgage advisor. This is not by any stretch a comprehensive conversation about all the investing topics and jargon that you'll hear out there, but it's very high level, and for those starting at the beginning and just looking for some guidance on where to begin when you want to start the investing process, this is going to be great for you. First and foremost, let me just say this is for educational and informational purposes only. Always make sure you consult either financial advisor, your CPA, or attorney to gain specific advice and have some more conversation about your specific needs. So very high level, if you are starting out and wanting to look at investing, you're going to typically see ways to invest in individual companies like individual stocks. You can look at mutual funds. You probably have heard the term index funds. You might have heard the term ETF, which is exchange traded fund. You probably heard of bonds and T-bills and money market accounts and CDs. Those are all great ways to be invested. And the big question is, how do I diversify? What should I put in where? How much should I put in which one of these funds? And that's a very big question. And the answer really depends on your situation. It's very, very individual. So I can't tell you, oh yes, it makes sense for you to put in 80% of your money into this fund or anything like that. It depends on your age, it depends on your risk tolerance, it depends on when you're going to need those funds. Very high level, typically, if you are going to need those funds anywhere in the next, say, 5 to 7 years, you should not generally be invested in the stock market. That is because the market is volatile and you've seen it come up and go down. And the last thing I want you to experience is needing those funds, maybe for a purchase of a home, a down payment, or funding of, a wedding, something of that nature. And then the market's correcting and the market's down and you've lost, a percentage of your assets. So anything, again, 5 to 7 year range, you want to keep it more conservative. So consider treasury bonds, you can consider treasury bills, money market accounts, CDs, something of that nature that are a little bit safer and a little less volatile. The stock market, is really meant for long-term, long horizon investing. So if you're looking at 7 years or more, that's a great place to explore investing in the stock market in general. So whether you invest in individual stocks, mutual funds, ETFs, or index funds, that's the next question. So individual stocks are you don't have diversification if you're in one company, unless spreading out within many different companies. If you're just starting out in the investing process, I would recommend you explore index funds. Index funds are the low cost, if you will, way to invest in the market. It is a passively managed type fund. So that basically means the expense ratios are going to be lower for that. And that means that you keep more money in your pocket. It's less money to manage those accounts or manage those funds. So that savings is passed on to you essentially. You can invest in the S&P 500 index fund, which is investing in the S&P 500. So you're spread out. Your diversification is spread out among the 500 companies, which is a great way to get your feet in the door, if you will. So again, they have lower expense ratios. Mutual funds, on the other hand, are more actively managed, which means that portfolio managers are in there managing the assets and buying and selling more actively, which means that the expense ratios are going to be a little bit higher. So that means you keep less of your own money. They're both good, they're both fine, but if you're starting from scratch and you're starting to invest, explore the index funds. They're just a great way to go. An ETF is an exchange traded fund. That is not a mutual fund. But it's a way to invest in a fund that trades like a stock. So what I mean by that is when you go purchase a stock, an individual stock, and you're in the market, you push a button buy or sell, it's triggered at that next market order, that next time when the trade is essentially completed, and that can happen during the day anytime. When you invest in a mutual fund or an index fund, you are basically trading at the end of the day. So in the mutual fund specifically, you are buying, perhaps you buy it at 10 in the morning or you sell it at 10 in the morning. Well, it doesn't trigger until the end of closing, the market closing that day. So whatever the closing price is of that day, that's the price you pay or the price you earn when you buy or sell. So an ETF is a fund that allows you to trade like a stock. So explore all of those as ways to get started. Again, back to the question as far as the diversification piece, look at your time horizon. If you're looking at 7 years or longer, you can afford to go into the market. If you are looking for less, stay more conservative, stay in more less volatile type products, like, again, the treasury bonds, bills, CDs, money market accounts, high yield savings accounts. And then your risk tolerance and just other factors of your life. How soon you will need those monies to live off of if you're retired, or if you've got some very large big ticket items like a wedding, again, or a purchase of a house. Again, I'm going to reiterate that you speak to your financial advisor, you speak to a CPA, an attorney, speak to someone who's experienced and that you respect and trust to determine how to diversify those assets, because this is your money and you want to make sure that you are mindful of how that's diversified and invested. But that's a great way to get started. So any questions, feel free to reach out to me. Again, that's very high level. This is a very complicated, very deep conversation. I'm not going to go into the nitty-gritties, but I welcome your questions, and I can film another video based on your questions, so feel free to do that. Please subscribe, like, and share, and hopefully you can get the bell notification when new videos come out. And I'm also going to invite you to jump over to mindinghermoney.com. I wrote an ebook that is a complimentary download for you. It's Women Soaring Solo. It is a financial guide and a survival guide if you are recently widowed or divorced. And then you'll watch a free training. So great way to get some more information a little bit deeper than what we spoke about today. And hopefully that gives you some very high level, helpful information. All right, bye for now.